we did some calculations. So let me move on to the rest of that particular question, and especially the convexity part. Anyone tried to do it, the convexity adjustment and the what you call differences?
Sir, good morning.
Good morning.
So can you share that Excel sheet with us, which you did
No, I will
last
send the answers because Excel sheet you have to work out. I will send the answers so you can look at how do we do. That is important thing. Rather than getting prototype. So I will send the answers to the questions. You have to work out answers. So that is the important thing. So you have to use the formula. So you have to practice how to do it. So I will send the answers so that you can practice at home the same way. Okay. So we were looking at this particular question. So we, I think we did the question number 6. I think compute the price of the bond if yield increases by and decreases by 1 basis point. Have we done it? I think that part we did, I hope. Didn't we discuss that part?
Yes, sir, we discussed.
Okay, so we know, okay, that part we know. Okay. Everybody have the answers for question number 6, convexities. Okay, we'll move on to the last part then. So now use the formula, compute the convexity of this bond and derive the price of the bond using convexity adjusted duration, right? So basically now rather than using, because we saw, okay, okay.
Okay, sir. Now it's okay.
Sorry for the interruption. This is the problem in Sri Lanka. See, we are talking about technology online, but always, this not working properly up to the standard. Now I have to use private network now, dialogue network to log in now. So this World Service by Sri Lanka Telecom. Okay. So let's move on to the worksheets again. Okay, so let's look at 1 basis point change, how we worked out. Okay, so remember that for 1 basis point, we got price change 0.4621. But if you use the formula, formula is basically same formula minus D times, delta R times the value of assets divided by the price. So the value of that means the price of the bond divided by the original interest rate. Okay, so that is 4.993 times because 1 basis point means in terms of percentages 0.0001 times face value of the bond is 1000 divided by original interest rate yield per 1.08. So you see now for a small change in interest rate, you use the formula, you get minus drop in price is 0.4623. Similarly, if you use the normal calculation, you get 4621. So basically, they both are same. So that is the important thing, because for a very marginal small changes, we can assume the there is a straight line. But of course, for larger changes, because curve the yield curve is in such a way, so the bond curve is in such a way it's convex. So you have to adjust for that, right? So similarly, you can do for what you call the decline of 1 basis point, that is from 8% to 7.99. So you will get the change in price 0.46243 using the normal way, and you get the other positive side, same as earlier, that is 4623. So it is exactly the same, because when you use the formula, it's either side you get the same answer. One is positive, one is negative. So you don't have to work out again when you use the formula for either increase or decrease by same amount, only the sign different. If it is decrease, it's a positive value that increases, but if it is decreases, it's a negative value. So it's 4623, and here also you get 46. So it's exactly the same, no change at all. So that is the difference. So let's work out the convexity. Now I think I taught you convexity formula. Convexity is 10 to the power 8, positive change plus negative change, and so on. So if you use the convexity formula, what could be the answer? Okay, so because if you go back to your notes, you will have the what you call convexity formula. So it is, you can refer back to your notes. Okay, you get duration times. Now here we are we look at the 2% increase in interest rate, that is up to 10%. So it is minus duration times the change in interest rate, positive 0.02, divided by 1 plus R, 1.08 plus 0.5, and okay, the convexity. Now, if you convexity is, now if you work out the convexity, as you know the formula, convexity is 10 to the power 8 change in positive change as well as negative change. Okay, the negative change is delta P minus divided by P, that is 999.53785. You got in your answer, previous answer. Okay, here this one minus 1000 divided by the original face value 1000 plus the positive change that you worked out here for a declining 1 basis point. So you will get the convexity of 28, right? Your convexity is 28. So if you use that formula, okay, you will get the price, okay, price is, okay, using this formula, change in price, 0.5 times 28 times the change is delta R to the power 2, that is 0.0 to the power 2 times 100, okay? That is for the percentage. So you get a negative 8.68 percentage, right? So if you work out that for the original formula of 900, the 1,000 rupees, so 1,000 plus 1,000 into H10 is this one, okay, change divided by 100, right? So your final price is 913.91926. Then for the interest rate decline, again you can work out. Now we have same formula, no change, minus 4 point duration is same, but here the delta R is negative because interest rate decline, and the rest of the things are same, there is no difference. You know, only this one change, and here the delta R is minus 0.02, but when you square it, it will be a positive number. So you end up with a 9.80% change, and so your price is 1,098.007, right? Now look at this price with the original prices you got. Now let me move on to, okay. Now this is the original price. When we use the formula, we got 912.89, right? So I'll put it here. 912.89. Okay. Then I'll put, when we work out the direct formula earlier, how much we got. Okay, that is 900. Okay. We got, I think, 907.54 because change is 92.46, 907.54. Okay. I'll put it here, 907.54. But that is for the increase in interest rate. Now, for the decreasing interest rate, we got 1,098.35. And we got that is for the decrease, we got that is 1,092.46 because it's a positive increase, 1,092.46. Okay, can you all see this? Can you all see this, please?
Yes, we can see.
Okay. Now look at these three numbers. Okay. Now what is this sorry, I'll start with the bottom part. Okay, what is this 1,098.35? Can someone tell what is this 1,098.35? Can someone tell? So if you don't understand this, you can't compare and give a, now let's say if you were to answer question Okay, work out this manner, compare and contrast or whatever. So you should be able to explain the results. The important part is not just get the numbers now. In your working place, the computer will derive some numbers, but important is interpretation of numbers. So what is this 1098.35? We did last week. Can someone tell? What is this 1098.35? These four numbers are we derived last time. It's not some only these two numbers we derived today. So these four numbers we derived last time. So what is this 1098.35? This number.
Price of the bond if the yield decreases to 6%.
Price of the bond if yield
Decreases to 6%.
6%, add little bit.
Yeah.
Add little bit. This is all these are prices. All these are price of the bond. What price?
Using the bond calculation formula?
Exactly. You bond calculation formula. Exactly. If you use the normal way, bond calculation formula, this is the price we got. Remember last week we did? This is the price we got. Using the bond calculation, normal bond calculation formula, that is price equal coupon divided by 1 plus R plus coupon divided by 1 plus R to the power 2, multiply by the time factor, that is the numerator, and divided by the value of the price of the bond, that is again without time factor. We did all those last time. So this is what we tried last week using that formula. That is the price of the bond when the interest rate declined by 2%, that is to the 6%, using the normal bond formula, right? So what is this? Can someone tell what is this? This also we derived last time.
Price of the bond using the duration formula.
Formula for what?
For interest rate at 6%.
Exactly. Right. So understand what we say now. This is the because it is now online important. You have to be at the lecture because you have to be very mindful. If you have any problem, please ask questions. So this is what we did. You are right. Price of the bond, if yield declined to 6% from 8%, okay, and calculated using duration formula. You know duration formula, delta P over P equal minus D times delta R over 1 plus R. So typical straight line sort of a formula. Okay. So what is the inference or observation when we look at these two? Can someone tell me this we derived today?
Price of the bond after adjusting the convexity.
Yeah, exactly. Yeah. So price of the bond for 6% yield after adjusting to the convexity without using the straight. Now this is straight formula, but we worked out this using the convexity adjustment factor, the formula with the convexity. Okay. So you are right. For 6%, now interest rate declined to 6%. Now we arrive three numbers. Using the bond formula as it is, we get this number. If you use the duration formula as it is in the straight line basis, this is the number. And this is the number if you use the convexity adjusted formula. Right? So what do you see? What do you see? What do you see? What things you can observe? I mean, senior bankers, you can observe things and explain. I mean, don't take, big, knowledge or something. Just you look at the numbers, tell me what you see. I mean, as bankers, you must come out quickly. I mean, most of you are very experienced bankers. What do you see? Very simple
The
thing.
value.
3 numbers, just to tell something about these numbers.
When it is adjusted for convexity, the price of the bond is very closer to the price that we obtained using the normal
Duration.
bond calculation form.
Exactly. I think you have to talk. I think I like a more interactive session because this is the problem in Sri Lanka. We don't, we just learn the theory, have a lot of qualifications, but no use if you don't interact, discuss, clarify. You have to observe things and come up with, answers. So that is the, way that I think senior bankers should act. Okay, only a couple of, bankers talk. So what do you see? It's very clear. So this is the normal bond calculation formula you use. And this is what you did use in the convexity adjusted formula. And this is without the convexity adjustment. So basically, these two numbers are quite close. And here in this case, of very marginal difference. So that means, now, if you look at a large bond, now say 30-year bond, the using the bond calculation, it will be a tough task. But always we can use the duration methodology to compute the changes of prices. Changes of prices, and also duration is a conceptual, framework which you can use for the interest rate risk management. So that is the important thing. So duration, because duration is a benchmark indicator that any risk manager can use to manage the portfolio. Okay, portfolio of interest related instrument on the either side, asset side or liability side. So that is the important message. So there is no hesitation. Any banker or any risk manager could use for any large changes in interest rate, convexity adjusted formula for the bond calculations, right? So that is the important part. That is one thing is to compute prices. Other thing is to use the duration concept for risk management. So that is the purpose of this interest rate risk management. So similarly, when I go back to the increase in interest rate yield, for 2% increase, you get price drops to 912.89 using normal formula. But if you use the straight line without convexity adjustment, it's quite different. That is 907. But if you use the convexity adjusted formula, there is about almost 0.3 decimal places, 0.03 decimal places difference, but much closer. So the meaning is, whenever you have significant changes in interest rate movement, you expect, always use the convexity adjusted duration formula to measure your interest rate risk. Okay, so that is the important part. So always use the formula, which is the convexity adjusted formula, right, to compute the change. And you add that to the original price, that change. Okay, it's very simple. If you get a question in the exam, you will get the formula. Don't worry about remembering this formula, convexity adjusted formula. Okay, right? So, but only thing is, you have to be careful about your workings, right? So, so this is the last part of our question about the convexity adjusted formula and compare and contrast. So you should be able to work out any price of a bond using the normal way, That is the traditional formula for bond pricing or interest. I mean, here always I use, when I talk, I take bond, but it is for any interest rate related fixed coupon instrument. It could be a loan. I mean, I use the bond, but it could be a loan, interest rate related fixed coupon, right? So, so you can use this normal formula, or you can use duration formula with convexity adjustment for any large change in interest rate, either increase or decrease. Okay. So basically, this question covers whole, part of, interest rate duration calculations, price changes using the formulas. But then another important part is how you can manage your risk using duration hedging concept. So what is the important thing for duration hedging? What do you want to do? If you want to hedge against the interest rate, once you compute the duration, what you have to do? Okay, can you see my presentation again?
Yes, sir.
Okay. So what we have to do when we see the duration? As a risk manager, now ultimately the calculation is one thing. As risk managers, when we calculate and we come up with numbers, we have to do certain things as risk managers. So what we have to do? Anyone? Can someone tell what we have to do? So this is the risk management part. So the best thing would be, if we can, as a risk management, what we have to do is we have to maintain the duration gap at a comfortable level. Now, theory, if you can make the duration gap 0, then you are fully covered. Okay, but in practice, in a normal bank, you can't make your duration gap 0, but you have to have a benchmark duration gap target so that it is at a comfortable level. So your change or the equity value impact on the equity will be minimum. So that is the important thing. So if you go to the convexity adjusted formula, so if you can make duration gap 0, so I mean, this is for the one particular instrument, duration 0, basically for any interest rate change, this part would become 0. But still this part would be there. So you have to ensure that have a very small convexity instrument to minimize this. So it's just the duration, but also convexity of the whole, instrument. Okay. But if you look at the balance sheet perspective, so you can adjust the duration of assets, liabilities, okay, and the convexity. Okay, so if you can adjust the convexities as well, then of course you can manage your interest rate risk at a comfortable level. So depending on the criteria, you have to take a decision appropriately to manage your interest rate risk. Okay. So let me ask a question now. You have a duration of assets 5 times. Okay. 5 times. Duration of liabilities is 5 years, and duration of liability is 3 years. Okay. Let's say leverage factor is about 0.6. Okay, leverage factor is about 0.6. Duration of assets 5 years. Duration of liability is 3 years. And leverage factor is 0.6. Okay, what is the duration gap? That is first thing. Without, ignore the convexity, but without convexity factor in a normal way in a particular finance, now this is for the balance sheet, but for the financial instrument, particular interest rate related instrument you have in your balance sheet, duration of that instrument is balance sheet duration is of assets is 5 years. The balance sheet duration of liabilities are 3 years in that particular balance sheet of the bank. And the gearing factor is 0.6. DA5, DL3, gearing factor, the leverage of the gearing factor here refers to the leverage of the balance sheet is 0.6. So forget about the convexity. I am not referring to any convexity in the balance sheet. So what is the duration gap?
Is that 3.2?
Sorry?
3.2?
3.2. Anyone else? You are Miss?
Kasturi.
Okay, Kasturi, 3.2. So let's hear from others. What is the duration gap? Only one answer, but others, what about others? It will take 10 seconds only. Not something big to work out. It's basic mathematics. Others? What is the duration gap? Leaving any convexities, we don't have any convexity. Then it's a very simple duration gap. What is the answer? Samu. Others have to come up with quickly answer. Anyone else? What is the answer? So if you can't give an answer for this one within 10 seconds, if you get a question, it will take hours and hours to do a complete question. It's simple. We learn all those things over the last week. Very simple. Even today we discuss. What is the duration gap? If DA is 5 years, DL is 3 years, the leverage is 0.6 times. What is the duration gap? No one, no.
3.2, sir.
3.2. Okay, your good name? You miss?
Yuresha.
Iresha. So Iresha 3.2, Kasturi 3.2, only 2. I mean, we're pretty simple. What did you? Huh?
3.2.
Yeah, so 1 second job. It will not take a second. What is duration gap? I said, forget about convexity. dA minus KDL. That is the duration gap. dA is 5 minus KDL. What is K is the leverage factor, L over A. So 0.6 times L. L is 3, I said. So 5 minus 0.6 times DL 3. So 3 into 0.6, 1.8. So 5 minus 1.3.2. So duration gap is 3.2 years. Pretty straightforward. I mean, you have to practice and learn things. I mean, not just looking at that. That's why I don't want to give certain sheets, because you will become prototype. But to practice, work out and see how, come up with the problems. Okay, so as you do it, problems come, then clarify, then you will learn. Otherwise, you will become prototype. Even, even we give some presentations, which is a method I don't like, because we just get the presentation, forget about everything. You see? Sometimes not come for the class even, you get the shared copy, you just waste. So that is not the way. I think you are senior bankers. These are not like we teach in university or something. So you have to look at your scenarios. You can assume now how this in my bank, in my working environment, this can be done. Or how my colleagues is doing. Something like that. So it's 3.2. Everybody is clear? It's pretty simple. dA minus KDL. Duration gap is dA minus KDL. So D is 5, K is, that is leverage factor, K is the leverage factor, L over A 0.6 times DL is 3. So it's 5 minus 1.8, that is 3.2, right? Okay, so let me ask now 3.2. Now you are the risk manager. Okay. So you have come up with a duration gap number, which is the instrument we are going to use for the interest rate risk management. Okay. So for protect you from interest rate risk management. So, okay, what is the threat to you? Tell me. What is now, given this duration gap, what is the threat you have? What is the threat you have? Potential threat you have?
If these assets are not prepaid in full as agreed, after the 3 years, we have to face this repaying the liability to the customer.
What is the now here we are talking about interest rate risk, not the credit risk. I think you just refer to the credit risk. Inability to pay something is a credit risk. Now we are doing interest rate risk. So what is the threat here? Given these numbers, I explained to you. Anyone? Okay, you're fine. I mean, you can express, that's fine, because that's the way you learn. So that is the important thing. At least you express things, you know why it is not something right or something. That is the way. Don't worry about making mistakes, because you don't have to make mistakes only in the exam. In the class, you can make any amount of mistakes. This is the way. Even if someone asks certain questions, I may not be able to give the perfect answer.
If the asset interest rate goes up, there is an impact on the equity of the bank.
Exactly. So the potential threat for this particular bank is the rising interest rate, because your duration gap is positive. You have a 3.2 duration gap. Okay, duration gap. So when your duration gap is positive, the threat is the rising interest rate. Threat is the rising interest rate. Okay. Threat is the rising interest rate. So if the interest rate rise, it's a potential decline in value of equity. Right? So now as a risk manager, your risk is the rising interest rate. So if when you see the potential threat to me is the rising interest rate in the future, so based on your duration gap, then you have to take appropriate measures now. So that is now always risk management is coupled with the what do you call economic management. So that's why in many banks there are advisors for the economics functions. Maybe risk managers themselves look at certain economic fundamentals. So then you have to look for whether in the foreseeable future there's a potential to increase in interest rate. Right? So there's a potential to increase in interest rates. Okay. Now I'll come to the third question. I think the third part. Okay. So if you based on the macro fundamentals, everything, your economies forecast in your bank, there's a potential for whatever rise in increase rates, whatever rise in interest rates. Then what you can do? Tell me. What options you have available given these numbers in your balance sheet? What things you can do? Because when you see the things, you have to manage risk, because you don't have any control over the interest rate. That is a macro variable, right? So those are macro variables. But in your bank, you have a control on your asset and liability structures. Okay, that you have a control. But market variables, interest rate, foreign exchange rate, the equity prices, commodity prices, because those are the four variables which changes in the market where we don't have a control as a banker. So that's why we call market risk. Risk arising from changes in interest rate, risk arising from changes in foreign exchange rate, equity prices, and the commodities. Now here we are talking about the interest rate risk, the risk arising from changes in interest rates. So what you can do, now you identify the duration gap, you identify the potential threat. Now you are, analysts have forecasted, yes, there is a potential threat, there is a possibility of rising interest rate. Now you are the risk manager. Now what you have to think of?
Canvas more liabilities
Canvas more liabilities.
to substantiate this equity.
Sorry?
Substantiate the equity risk on
Okay.
leverage to cushion our leverage.
Okay, canvas more liability, but if you little bit elaborate, firstly the technical parts, and then the way, I mean, you are partially correct, I said. Okay, so let's first focus on the theoretical part and then link it to the practical part. Okay, you gave a good try. Okay, anyone else? Or
Maintain long-term liabilities.
okay, again, you also right, but come up with first technical part. Okay, you are right. I am both of you are right, but just tell me the technical aspect of it, then go to the rest of it. I mean, both of you are right, but first go to the technical part. Technically, what we have to do, then how do we do it? I mean, both you are right. Technically, I'm first part is technically how you do it, what you need to do. So then it's much comfortable. We are comfortable when you know the technical part, then apply practically. Okay, both of you gave a good try. Just elaborate technical part first, then link it to what you said.
Modify the duration.
Sorry?
Modify the duration.
Yeah, so okay, modify how?
Change because
If you little bit elaborate. Okay.
Increase DA.
Increase?
DA.
D?
DL.
or L?
DL.
Okay. Okay, now what is the first principle we discussed? If you want to manage interest rate freeze, what we have to do? Always go by the first principle. What is the first principle? Even a few minutes ago, I discussed. What is the first principle? That's why theory is important to get the principles behind it. But then, as bankers, how we apply? What is the first principle?
Make the gap zero.
Yeah, that is the first. Yeah, okay. So I'll put this way: minimize the duration gap. If you can make the gap zero, that is perfect. That is perfect. But in practice, practical life in your bank, you can't do it. That is the reality. Because there is a theory, there is a reality, no? So we have to understand the reality. Okay. So theory says, okay, if you can make the gap zero, that is perfectly fine. You are well covered. But in practice, can't do it. So what we try to do is minimize the duration gap as much as possible. So you try to keep the duration gap at a comfortable level. So you can use different ways to maintain that. Now, in this particular questions, we have a positive duration gap, right? 3.2. So we have so many ways of doing it. I'm still going by the theory. So if you want to reduce it further, what ways you can do it? You can bring down the duration of assets. If you bring down the duration of assets, again, your gap would be lower. You can increase the duration of what? DL, liabilities. You can increase the duration of liabilities. You can do both parallelly. Simultaneously, you can structure the balance sheet, asset and liability. That is someone previously you told, long-term liabilities or whatever. So you can structure the K. K is the LOA, leverage. So you have many options. I am still talking about theory. Yeah? Don't mix up with practice. You have a control of duration of assets adjusted to bring down. Duration of liabilities is to be increased, or both in whatever appropriate way, or adjust the leverage factor by restructuring the balance sheet asset and liability. So these are theoretical options available. as a risk manager. But each one has a possibility and impossibility and a cost. Each one has a possibility of doing, even though in theory you can do all these things when you see the theory, but in practice you can't do all of things at a one time. So that depends on many other factors in the current environment. Just because you want to do something, you can't do. I am talking about now practical side. Okay. So you have to look at all those practical sides in that context and take a decision to do the best possible option with least other impacts. Now for take example. Okay. So I'll go to the liability. Now you said you can increase the duration of liabilities. Okay. So how do you can do it practical? Now we'll come to the practical side. How you can do it?
Take long-term deposits.
Okay, that is one way of take long-term deposits. So you can replace your short-term deposits with more long-term deposits, so that naturally your duration can be extended. So what is the related other concerns? What is the related other concerns? Huh? Okay. You are right, but there are other concerns. I just want to bring in practical things. I mean, this is the way, but you have to look many other things as well when you take the best possible option. So what is the other thing? When you do that, what other thing you have to look for?
The long-term deposits you have to higher. Have to pay high interest rates.
I can't hear you, miss.
For the long-term deposits you have to pay higher rates.
More?
For the long-term deposits you have to pay higher interest rates. So your interest expenses get increased.
There's a some like echo sound coming. To long-term deposit you have to pay. You said something. I can't hear that part.
You have to pay higher interest rates.
High interest rate. Okay, you are right. So if you want to adjust the duration of liabilities, you want to raise more long-term deposit, but which in turn has a other part. While duration adjustment itself to control your impact on equity, but you will forego some interest rate. Isn't it? Because those long-term deposit, you have to pay higher interest rate. So that will have impact on what on what?
PN, bottom line.
Yeah, net interest income, it will have. So that's why I said sometime back, I told you something.
Canvas more demand, low cost or no cost deposit.
Okay. I told something. Wait.
If you can increase the higher deposits,
Okay, now look at, this is something we discussed previous class or even the class before. Now first point, the bank can protect either market value of equity or the book value of the net interest income, but not both. So this is a critical statement. The bank can protect either market value of the equity or the book value of net interest income, but not both. You can't have the cake and eat the cake. So either way. So you see, when you adjust the duration, of course, it's an impact on your net interest income. But the idea is you must find the way which minimize both aspects. Okay. So, but you can't protect both. So try to do the best possible way So then you can bring down and also the market appetite. I mean, so many things you have to, I mean, just because you want to raise more deposits, long-term deposit, there is no appetite in the market for such long-term deposit in that particular environment. So you have to look at the market. What is the appetite for long-term, what do you call deposits? There is appetite. Are there any demand? I mean, when you say long-term, if there is no demand at that sense, so it's a broad way of looking at the best way. But in theoretically, you have to bring down the interest, the duration of assets. You can increase the duration of liabilities, or you can restructure the balance sheet through many practical ways. Okay. Now, again, one way is issuing some long-term debentures. Long-term debentures, right? That is another way. So long-term, the debentures are anyway medium term, so about 5 years. So that may be another option, but again, interest element is there. But there may be other advantages of banks doing that, because there may be advantage of you can take into tier 2 capital. So there are so many other aspects as well. Okay, so similarly, duration of assets. So in future you can restructure with more shorter medium-term loans, or maybe placements with short-ended instrument. But again, it has an interest rate impact. So this is the way, as risk managers, you can look at managing your interest rate with the duration model. So basically you forecast, and also, but now if you go to the, if you couple with the convexity, not just the duration, you have to look for the convexity factors as well. So see what is the convexity gap as of the balance sheet. Here B1, B1 is this one. So you have to make that also very much closer to 0, because there is impact arising from here, right? So you can have a look at convexity factor. So this is for long-term interest rate changes. So you can look at the duration of assets, duration of liabilities, the leverage factor, as well as convexity of your balance sheet, assets and liabilities. So that is the other factor you have to look for when you look at the whole balance sheet point of view, when for substantial interest rate changes, when you expect, right? Because we need to look at the convexities also. So it's DA, DL, K, the leverage factor, as well as convexities of your balance sheet structure, assets and liabilities. Okay. Now let's move on to the final part of the duration. Okay.
So excuse me, sir. In this formula, BO stand for zero bond value at the 0 year, and B1
1
is
plus
for
the 1 divided by BO means 1 divided by 1 plus original current market interest rate.
okay. So that means the prevailing current rate.
Yeah. Now let's say today, if we are in an overall basis around 8% interest rate, current market interest rate, then that is the current interest rate. Now let's say if you expect that overall interest rate going to 10%, then you have to work from 8 to 10%.
Okay, sir. Thank you.
Okay. Now here, of course, you have to take the weighted average rate. I mean, this is not just for the one element, no, this is for the balance sheet. So you have to compute a weighted average interest rate, right? Current weighted average interest rate. Okay, let's move on to the final part of duration modeling. The problems with duration model. Okay. Now, the first point is duration matching can be costly. And immunization is a dynamic problem. Now, I think these two going together. Now, what do you mean by Now, when we look at the numbers, always there is a risk depending on the size of the gap. So as a banker, what you have to do is you have to immunize yourself. Immunize means hedging. So to immunize means you need to maintain duration gap at your comfortable level. Right? Can you all hear me, please?
Yes,
Yes,
sir.
sir.
Huh?
Yes.
Okay, because there's rain outside. So whenever you see uncomfortable duration gap, you always need to immunize against the possible adverse interest rate movement. But in practice, I mean, you can't stop at one time. Every day you have to look at, every day you have to do it. But it is not easy. So that's why it's costly. I mean, you can't do every day whenever the duration gap increase or decrease based on the potential threat. You can't adjust. So that's what. Now let's say you issue some long-term deposits. 1 month later you find opposite. So you can't reverse it. Or you can come up with another element. So it's costly. So it's not, we can tell many things, but it's not easy. And again, the large interest rate changes and convexity, because we can't use the simple formula for large interest rate changes, but we can use the convexity adjusted formula. Now the flat term structure. Now we assume the term structure is flat. Okay. And the ups and downs are same. Flat means it's a straight line. Straight line, and movements are also parallel, flat. But it may not be the case. There may be, remember, there is a basis risk or the yield curve risk. Okay. Then problem of default risk. Now, we don't consider any defaults. Now, when we compute the duration, we go by the cash flows as per the book. That means, now let's say particular loan. So when you want to measure the duration, you assume these cash flows will come on that time, isn't it? But if there is a default, then of course your calculations of whole duration will go wrong. So it's a problem with the model. So we don't take into account the default risk. And also the duration of demand deposits and savings deposits. Now, generally, very difficult, because now maturity and the demand deposits and savings deposits, difficult to predict. Now, of course, fixed deposit we know, bond we know, okay, but demand deposits very difficult, and savings, because I mean these are few issues. I mean, still you can have your own assumptions and experience to model it. So this may vary from one bank to another bank. Okay. So that's what we said. Even now we looked at repricing gap model, that only the book values. So it is not the best. So we move on to the maturity, where all cash flows are taken. But maturity is not the real maturity. Then we move on to the duration. So even duration, there are some issues. So we don't have any perfect model as such. But subject to some limitations, these are the typical models used by banks for capturing the interest rate risk. Right. So let's move on to the question number 2. Okay. So we'll look at a little bit risk management perspective, how we can do this. So very, very, simple example to illustrate how we can use the different tools, different ways. Now suppose that a small investment bank has developed a 5-year deposit product with guaranteed effective annualized compound interest rate of 8%. Okay, 5-year deposit product, guaranteed effective annual compound interest rate of at 8%. So it's a compounded at 8%. That's a 5-year deposit. So each deposit certificate has a value of 1,000. So the face value of each deposit certificate is 1,000. Deposit cannot be withdrawn prematurely. So there is a condition you can't withdraw prematurely. So there is no premature withdrawal risk. So it's only at the maturity. As per the bank's investment policy, banks' investments are restricted to only government and corporate bonds. So there is investment policy. Investments are only in government and corporate bonds. And the bank adopt duration model to manage interest rate risk. So the model they follow is the duration model. Bonds are actually traded in the market and have a face value of 100 or 1,000. Discuss two possible strategies available to the bank to manage interest rate risk. Right. So you have active bond market. There are bonds with face value 100 to 1,000. And there is a bank's investment policy. And you have given a scenario. Okay, so think about two strategies available to the bank to manage interest rate risk. And prove your answer with relevant cash flows to the bank. Okay, can you all work out? Start working out. Think of two possible strategies. Now we have learned all background theory. Okay. And think of two strategies available to the bank, the manager interest, but only thing is prove your answer with relevant cash flows. So when you adopt a strategy, tell exactly how, whether that strategy will result in managing your interest rate risk. Okay. So can you start working on that for about 10 minutes? So we can, you can start working on, so we will discuss and you can see whether you got, okay, at least one way, right. So you have to have a strategy. Now you are issuing a deposit product, 5-year. Now you have to ensure the interest rate risk. Okay. Think about it. Start working out different ways, and we will look at the answers. Later. Okay, hope that you have done the answer to the question. Okay, so let's move on to the strategy 1. Now, okay. So what is the first thing now? Now, when you issue a deposit, raise a deposit of 1,000 at an interest rate of compounded interest rate of 8%. First, we have to calculate what is the face value of the, the maturity value of the deposit. Okay. So now the maturity value of the deposit is 1,000 into 1.08 to the power 5. That is 1,469. Okay. So one strategy, what is the first strategy, would be very simple strategy. Now to match this cash flow as it is, now I'm taking a very hypothetical scenario, but to exactly match this cash flow, probably we have to invest in a asset which will end up with giving us 1,469. Okay. So theoretically, so if you divide it by the question says there are bonds with face value 100, right? So if you take a bond with face value 100, price of a bond at maturity, price of a bond today is 68.06 because the price equal face value divided by 1 plus r to the power time. So the 5 years zero coupon bond means the price is 60.06. Okay. So if such zero coupon bonds are available, for the deposit we mobilize 1,000 rupee, we can get 14.69 such deposit. I mean, just for the theory, because now reality you can't get 14.69, either you have to get 14 or 15, but theoretically you have to get 14.69 bonds. So if you get 14.69 bonds of face value 100 at the end of the 5 years, that is at the maturity of deposit where you need to 4,469, you will exactly get your money back. So basically your interest rate is covered in full. Okay. But in practice, you may not have 14.69. Either you have to buy 14 bonds or you have to buy 15 bonds, so that you will end up with 1,500 or 1,400, right? So that is a very simple strategy where you match your future liability cash flow with a investment in a 8% yield, maturity 5 years, zero coupon bond, right? Got it? Okay. Let's move on to strategy 2. Now, another strategy is to match. Now, what is the concept you use? Now, if you look at this particular bond, this deposit, what is the duration? What is the duration?
5 years.
5 years. Okay, maturity 5 year, duration 5 years. Now, if you look at this zero coupon bond, what is the duration? The zero coupon bond duration?
5 years.
5 years.
5 years. So basically what we do is a duration hedging. Simply we match duration of this liability with an instrument which has a duration of 5 years. So that is the risk management what we do, nothing else. So we match duration of liability with our duration of asset. So that at the end of the maturity of this deposit, we are end up with receiving a similar amount of cash flows, whatever the market interest rate going to be in the future. So that is the duration hedging. That's the concept we use. So now let's say we don't have zero coupon bonds. So if we don't have zero coupon bond, we have to look for a coupon bond. So when we look for a coupon bond, what we have to do, again match with the duration. Now remember a previous question, we found a bond with duration 5 years, remember? What is that bond? 5 years means almost it's 4.993. It's very, I mean, it's almost 5 years. Remember previous question when we work out this particular question, what was the duration we computed? 6-year bond with 8% coupon, 8% yield. What is the duration? 4.993 we worked out. Okay. So we can use this particular bond because that bond is mature. The duration is 4.993. So that is 5 years. Right? Now, so the first strategy would be to match with a 0 coupon bond with a 5-year maturity at a yield of 8%. Then your problem is solved. The second way out is, now if you don't have 0 coupon bond, we know that this particular bond with 8% coupon and yield, 6-year maturity also have a duration of 5 years. Okay, that is 4.993. There's a slight difference between 5 and 4.993, but this is a good hedge. So, but now how do we know whether we are fully insured? How do we know whether we are fully insured? Right? How do we know? So let's take an example. Now you have to justify because the question says, please justify your answer with the appropriate cash flows. How do we know whether this will hit? Now previous one we proved these are my cash flows. So I will get 14.69 coupons, bonds of this particular 0 coupon bond. So we will get at a price of 68.06 today using this 1,000. And at the maturity, we will end up with this 1,469, which will be used to pay the deposit liability. Now here, how do we know whether this strategy would end up with meeting our requirement? So how many of you came up with this sort of a strategy? Anybody? Anyone came up with this strategy? No? Okay. So let's move on to the justification. Okay, let's say interest rate will not change. Okay, once you buy in this bond, there are 3 possibilities. No, the yield may now the yield of this bond is 8%. So it may go up, may come down, or remain same. Let's say it remains same. If it remains same, what would be the price of the bond in 5 years? So now we have to settle the investment in 5 years now. Okay. So in 5 years time, the bond value will be, if interest rate remains same, because 8%, okay, would be 1,080 divided by 1.08, right? That is 1,000. 1,080, because after 5 years, you will get 1,080, okay? So divided by 1.08, if interest rate remains same, then 1,000. Okay, interest rate remains same. Then during these 5 years, okay, during these 5 years, you will get 8% coupon. That it means for 1,000, you will get 80. So over 5-year period, you get 400 as coupon, right? Then these coupons you will reinvest at an interest rate of 8% because that is the market interest rate. So the coupon will be, if you use the compounded formula, coupon would be 1.08 to the power minus 1 divided 0.08 times 80 minus 400. Okay. Original coupon value. Okay, that is the compounding. I mean, I'm not going to teach this because it's a compounding interest rate formula. So your coupon will be 69. So you will get 1,000. You will get your 400 coupons during this period, and reinvestment you will get 69. So altogether you will get 1,469. So which is exactly the same as your deposit liability. So if the interest rate remains same, we don't have any problem. We proved it. So let's say interest rate dropped to 7%. You can work out for anything, 6%, 5%, anything, but let's say I put 7%. Now, price of the bond in 5 years, 1,000 plus 80, that is the coupon, you get 1,000 plus 80. And the market interest rate drops means price will go up. Now, the yield is 1.07. So, you will get 1,009. Because interest rate drop, your bond will go up. You know, because this is a 6-year maturity bond. Remember, after 5 years, you get your face value, after 6 years, you get your 1,000 plus your 80. So 5 years price is 1,080 divided by 1.02, 1,009. A coupon will not vary because over the 5 years, it is fixed coupon, 8%. You will get over the 5 years, 400. Now, interest component, okay, now you will not be able to invest at 8%, 7%. So your new reinvestment coupon is only 60. Now earlier it's 69. Now it has dropped because the interest rate dropped. Now your total income would be 1,009 plus 400 plus 60, 1,469. Same. So even interest rate fall to 7%, you will match your liability cash flow with your interest investment cash flow. So we are happy. So let's say interest rate rise to 9%. I mean, you can work out for anything, 10%, 15%, anything. So if the interest rate rise to 9%, so what is the price of this bond in 5 years? So we get your face value in 1 year's time, 1,000, and your coupon 80. Again, same, that won't change after 5 years. But the market yield has changed, so it's 9%. So you will, now bond will price will come down, 991. Coupon, you will get same coupon during the 5 years, 400. Now reinvestment coupons, now you get a higher amount because you are reinvesting at a higher interest rate. So you will get 78. So altogether you end up with 1,469. Okay. So what does it mean? Whether your interest rate remains same at 8%, interest rate drop below 8%, or interest rate rise above 8%, your cash flow need of this deposit, you can meet without any problem. So this is a perfect hedging for the example, right? So the second option we thought, so we match duration of this particular liability with the duration of an asset, which is a 6-year bond. Remember, 6-year bond. 6-year bond at a coupon rate of 8% and a yield of 8%. So there is no duration risk, interest rate risk as a result of any movement of it. So we can sleep. We don't have to worry whether market interest rate goes up to 15% or it comes down to 14% or whatever. Either way, whatever interest rate goes, you will get your cash flow exactly matching. Now, in practice, can we do this? Of course, may not be. But you can find an instrument which is very much closer to your cash flow requirement in the market. You may not be able to match exactly 1,469, but there may be now here in this particular question, say it's an active bond market. So the bonds are trading actively with different coupons, different yield, different maturities in the current yield environment. So you can find a coupon, a bond, which is somewhat closer to your duration matching of your liability. So that now In this case, you got a duration of 4.993. But you may not find a bond with exactly around 5-year duration, maybe 5.1, duration of 5.1 years, duration of 5.3 years. So you can find a very much closer duration bond so that you may be able to manage interest rate risk to a great extent. You can't complete. Now here, for the explanation purpose, I got exactly matching instrument. Is it clear? Any questions before we conclude this duration part?
So in this question that like we are asked to come up with scenarios, strategies now. So like that we had this answer like 6 years. So if it's an independent question, do we have to start from at least adding 1 year when we are working for strategies?
1 year means?
That means that here that question asks for like 5-year deposit product.
Yeah.
So that we have to match the because this 5-year deposit means our liability side. So
Yeah.
when we are working with the asset side, do we have to at least add 1 year and work on a scenario? Can we start with the
No,
base?
you have to find out. I mean, it's not just depend on the maturity years.
Okay.
Now let's say let's say you have this is a what you call for explanation. The maturity of a deposit is 5 years, duration of also 5 years. Okay. Now let's say there is a deposit. The duration may be, now let's say you are putting up a deposit of 10 years. Forget about this one. 10-year deposit, interest is paid annually. Now that's a theoretical example. Interest rate is paid annually, right? 10-year deposit, but interest is paid annually. Then what is your duration?
It's 10 years, no? I know, because the maturity comes, the last outflow goes in the last year, so it's 10 years.
No, but you have to pay interest annually, no? So you have in between cash flows. It's not 10 years, less than 10 years. Now here you are compounding and paid at the maturity. You are compounding but paid at the maturity. So if you take any financial instrument, asset or liability side, which create in between cash flows, then duration is less than the maturity. This
So
is
we have to work on the duration.
Exactly.
The duration.
Duration, exactly. So you have to work out the duration. Now, for this particular 10-year deposit, the duration, let's say 9 years. No, I'll take, no, you are mixed up with 1 year, so let the duration is 8 years. When you compute the duration of this 8-year deposit, which pays annual interest rate, okay? Annual, I take a simple example, annual, it may be monthly, half yearly, whatever. So whatever, you have to compute the duration. Now, this example, we took the duration as 5 years. It is paid at the maturity compounded, right? So the duration is same as a zero coupon bond, duration 5 years. Now, if you have a 10-year deposit, which pays you annual interest rate, your duration is less than 10 years, right? Agree?
Yes.
Okay, agree. So let's assume we don't have work, we don't have to work out, it will take time. No? Let's say duration is 8 years. Then you are the risk manager. So what do you have to do?
Then the strategy has to come up matching with the duration of 8 years.
Asset. So
yes.
You have to look for an asset to invest in a duration of 8 years. Exactly.
Correct.
So now you have to go and look for let's say now you want to invest in a bond. Now, how do you are the risk manager? You thought, okay, now these are classic simple example of a one instrument, but if you look at a bank, it's totally different. So this is, let's say you have this one deposit product and now you want to look for a hedging. So you try to find out a bond, okay, with a duration of 8 years. So then in a market, there are different bonds. Now, some bonds have a coupon of 6%, 10%. So likewise, you have to calculate, you have to look for, let's say there are 5 bonds in the market. 5 bonds in the market trading at now. So you have to work out each and every those 5 bonds, what is the duration? Right? Let's say one bond duration is 10 years. So that may be a long-term maturity bond. Maturity may be 14 years. Another bond, you have a duration of 9.5 years. Another bond, you have a duration of 8.2 years. Another bond, you have a duration of 5 years. So then when you work out duration of all these 5 bonds, you will find a bond which is very much closer. I mean, if you get a bond with the exactly 8-year duration, you are okay. Well, you are comfortable. But you may not find an exact duration bond. So probably you may find a bond with a duration of, let's say, 8.2 years. Are you satisfied?
If it's the only option, we have to take it.
You are. I mean, that's why I told in practice, what's your name, Miss?
Eurasia.
Eurasia, no?
Eurasia.
Eurasia, the problem is now in market, you don't get the perfect scenarios. In theory, we tell this. So if you get a 8-year bond, 8-year duration bond, you are well off. Your risk is 0. But in practice, you may not get a bond in the market which is traded at that moment, which have an exact duration of 8 years. So what you have to do is, in practice, try to find out a bond which is very much closer to the duration of the deposit liability you are going to match. It may be 7.9 duration, it may be 8.5. So whatever the product which has a very much closer to your duration, you pick.
Yes, sir.
Right?
Thank you, sir. That means lesser duration cap, the product with the lesser duration cap.
Exactly. You can't perfectly match. It's like, you find a, partner. Okay, you try to match the horoscopes. There are 20 items or something like that. No? Okay, so I don't think anywhere in the world you will anybody believe in get 20 matching. Okay, so let's say at least 70% of the characters are matching. You assume it's like a drug. Now you see the vaccines. Even the best vaccines now called what do you call Pfizer, Moderna, still success rate is about 94%, no? 94, 95. So another one is less than that. So likewise, so still there is a 5% chance somebody may not be perfectly protected. So likewise, you can have a somewhat closer hedging. So that is the idea. But for the explanation purpose, I picked up these to show exact matching. But in reality, what you want to do is try to find out opposite product, investment product. No, it could be a loan. Now you can design a loan. Now I just brought example of a bond. It may not necessarily bond on your asset side. You can create a loan which will come to duration of 8 years. You can create a loan because that's a more easy. Sorry for the disturbance. So it is much easier for you. So you can structure a loan product with a duration of 8 years. Now that again, if you look at reality, there should be a demand. No, I mean, you can't simply create a loan. No, so there should be a demand for such loan products. Okay, but anyway, the idea is match the duration. That is called the duration matching and duration hedging. Clear?
Yes, sir. Thank you.
So any further questions? But only thing is you should know how to compute duration. That is important. Now we worked out duration. So that's how now earlier bond we worked out a 6-year bond with 8% coupon and 8% yield. Duration came up to 4.993. So we know this 6-year bond has a duration of almost 5 years. So you have to look for the instrument and compute the duration. So this is different now. If you take now, that's why I said if you take example of a 5-year deposit, but which pays monthly interest. Let's say the deposit pays monthly interest. Then your duration is less than 5 years, right? Then you have to work out the duration of your liability also. Duration of your liability also. It's not just the duration of asset, liability, and first find out what is the duration of my liability. Then look for an opposite product for you to match that duration. So that's what happening in duration modeling. Now, for theory purpose, we took just one deposit, but now this will be applied for the entire balance sheet. So this is the whole purpose of this exercise. This is what we do. So we look the entire duration of asset, not just we look at your bank. How many assets do you have in your bank? Not just one asset. How many liabilities? So when you put now, really when you develop your duration modeling, numbers comes automatically. So numbers will come out of your model, but as risk managers, when you look at the numbers, you have to take appropriate decisions. So that is the important part. Now for the class, we used to tell you how to work out numbers, but in real practice, simply the model gives, okay, today my duration of assets is 9 years, duration of liabilities is 3 years, leverage is so much. So you know duration gap. Your convexities of the balance sheet, all this you know. This one, this one, this one, this one, this one, you know. Then, as the risk managers, you have to look for what is going to happen in the future. Potential threats as a result of your structure. Then you have to take appropriate measures. Right? Okay. Any more questions before we end up this particular session? Any more questions? No? Okay. So please work out, practice. I mean, you can work out some, hypothetical examples yourself and see. We gave some example because of the time factor, we can't do many more. But work out, I mean, take you issuing a debenture. Now take example, now your bank, all these days, many banks are issuing debentures. How many of your banks issued debentures recently? I saw several banks going for debentures. Anyone? Your bank came up with debentures?
Not recently, Mr. Jan. Somewhere back in March, Ceylon Bank issued some debentures.
Okay, so your bank has, so you can work out. Now, what is your debenture? Now, when you issue a debenture, you create a liability product in your balance sheet. So try to work out the duration. So then you have to match. I mean, I'm bringing individual example, but this will change the whole balance sheet structure. DL will change. Individual liability will result in a DL change. But automatically you can compute, let's say, thinking only that product, what should be the matching product, right? So practice some examples in your own. Everybody can have a hypothetical example. This is what I'm going to do in my bank. So what is the risk management tool I am going to use? So I worked out a couple of examples. Now, everybody should be thorough with how to compute duration using the formula, using the duration model, whether it's a very small interest rate change or large interest rate change, using the convexity. Okay. And also how to match your liability with asset. Right. Okay. So I think all of you are comfortable. We'll stop for a tea break for about 15 minutes, and then we will start with the new area. Now, after the break, we are going to look at how the different derivative products are used for hedging, right? So that is the after the break, right? But practice, because whatever we did, practice several times. So repricing gap model, identify the theory, and identify the risk. As a risk manager, your job is to identify. So if we have a negative duration, negative repricing gap, what is the potential threat? Okay, if you have positive duration gap, what is the potential threat?
Increase of interest rate.
Sorry?
Increase of interest rate.
I can't hear you, miss.
Increase of interest rate.
Still, what is that? Interest rate?
Increasing.
Increase, okay. If you are, no, sorry, if you have positive duration gap,
Yes.
I am referring to repricing gap, huh? Repricing gap. If you have positive in repricing gap, not the duration gap, repricing gap, then what is the risk to you? Interest rate decline. Not the duration gap. Reprice first model. If you have positive repricing gap means you have more rate sensitive assets than rate sensitive liabilities. Okay, so you have a negative impact if interest rate decline. So understand this thing. I mean, what is important is when you see certain thing happening, derive what is going to happen. What is the risk to be? Always, interest rate movement upward or downward may not affect you. All depend on your position in the balance sheet. If you take repricing gap, that is we measure the impact on net interest income. So you should be able to measure. Okay. And also understand why. Remember I showed a chart. Why? Why? When is it a positive gap? Drop in interest rate have a negative impact. Rising interest rate will have a positive impact. Right? So think about it. Logically think about, understand logically. I mean, that's why we don't want to, we as senior bankers, don't memorize things. Understand the logic, principle behind it. How it's going to happen. So when you have positive gap, you have more rate sensitive assets than rate sensitive liabilities. So when interest rate drop, the adjustments coming on the asset side is more than the liability side. So you are declining assets more, decline of interest income from assets is more than the declining expenditure from your liabilities. So you have a negative impact. So understand the theory. That is the important thing. Don't just memorize things. Logically think about how this is going to happen. Same duration. How when duration gap is there, positive, how it affects the change in interest rate. So think about it. Okay, so almost 10:51. So are there any questions from those sessions anymore? Okay, so we'll.
Sir,
Yes.
so excuse, it's a small request from my side that will you be able to incorporate these workings on Excel sheet also uploaded in the
No, I will.
Yeah.
That's what I beginning. I will tell the worksheets on. Okay.
Okay.
I will send you the working sheet, but you have to practice in your own.
Yes, sir.
Okay, so I will send the worksheets before during the next week. Okay.
Okay. Thank you very much.
But what is important, why I don't want to give the work exact sheet is that you have to practice your own. So identify how we did it, practice in your own. Right? So I will send the worksheets, Excel worksheets. Okay?
Okay. Thank you, sir. Okay.
Okay, then we'll stop for the usual tea break and we'll start the next area after the break. Okay, thank you. Okay, can you all see the presentation?
Yes, sir.
Okay. So we will move on to the next area, the managing interest rate risk using derivatives, right? Okay, before we move, are there anything to be cleared from the previous session? No? Okay. So in this particular session, we are going to look at different derivative instruments which we use to manage interest rate risk. The forward contracts, financial futures contracts, forward rate agreements, interest rate swaps, options on interest rates, such as interest rate caps and interest rate floors, right? So these are typical instruments which commonly used all over the world by many financial institutions as risk management tools. Some of them are used in our context as well, but some are not typically in local context. But many international banks probably use this even in a local context. Okay. So let's move on to the financial futures contract. Now, what is a futures contract? Is a commitment between a buyer and a seller on a quantity of a standardized financial asset or indexed. So it's when you talk about for interest contract, there's a commitment between agreement between a buyer and seller of on the quantity of a standardized financial asset or index. Now, index is usually related to mainly related to the market, equity markets, such as now if you look at Sri Lankan context like S&P, ASPI, and so on. Now, New York Stock Exchange also, they have certain indexes. Like so, it's basically index. There may be other indexes, commodity indexes, and so on. So it's a financial asset, like a loan, like a bond, or debenture, anything. Okay. The futures markets. Now, what are the futures markets? The organized exchanges where the futures contracts are traded. Now, generally, in many parts of the world, many countries like developed countries, they have a future market for future trading. Now, of course, unfortunately, we don't have specific futures market in Sri Lanka where these are traded on organized exchange. Now it's like a stock market. Now we know stock market is an organized exchange where buying and selling of equities are taking place. Now, similarly, futures market is a market where the organized futures contracts are traded. So the buyers can buy futures contracts and sellers can sell futures contract. Now, there are many futures markets now. There are markets for goods, the interest rate related instrument, equity related instrument, but our focus is on the interest rate futures now, the futures related to the interest rate. Okay. So the interest rate future is an asset, underlying asset instrument where the underlying asset is an interest bearing security. So any asset related to interest, so that will be called the interest rate futures. So let's move on to the buyers. Now, a buyer of a futures contract is to be on long futures. Now, there are few terminology we have to identify. We may go to the futures markets or even in other markets, we have a long position and a short position. Now, if those who involved in Forex, you have a long Forex and short Forex. So similarly, when you buy a futures contract, you are holding a futures position, in theory, we call long futures. So that means you agreed to pay the underlying futures price for the take delivery of the underlying asset. So when you buy a futures contract on a particular instrument, so you have to pay the underlying futures price at the maturity date or take delivery of the underlying asset. Now that depends on a different settlement process. So the buyers gain when the futures prices rise and lose futures prices fall. Because if the futures price rise, generally now if it is interest related, when the interest rate drops, futures price rise. Okay, then you will gain because you agreed to buy at a particular price, but then price goes up. So what you do, usually what happens is now you sell the future contract at that price, the price at the maturity at a higher price and settle the existing contract. So the difference is, so it's a matching line. Okay, you buy, then you have to buy, today when you buy a futures contract for 3 months, 3 months time, when in maturity, let's say the corresponding future price has gone up. Then what you do is, usually it is less, the deliveries are taking place. Usually what happens is, there's a settlement for the difference, right? Opposite happens if the price drops, because you agreed to buy at a particular price, but the price dropped because of the rising interest rate, and so you lose. Okay. And sellers, the sellers of futures contract is said to be a short. Now, when you buy the futures, you are go long the opposite party to future contract. Is called the selling the future or short. Okay, so when you sell the futures, okay, agrees to receive the underlying futures price or to deliver the underlying asset, and otherwise you have to deliver the underlying asset. Now earlier, the delivery of underlying asset, take the delivery of underlying. Here you have to sell the asset or receive the futures price. Now sellers gain when the price drops. That means interest rate rises. Okay, why? Because you gain because you agreed to sell at a higher rate compared to the rate going to be prevailed at that time. So you are gaining but lose when the price goes up. You agreed to sell at a lower rate than the market futures price at that time. Okay. So it depends on the, but only thing is now you can't expect either gain or loss in the futures market, because these are instruments used to hedge. So that what you want to ensure is to make certainty with respect to your pricing or selling or buying asset when the interest rates are subject to change. So the idea is the risk management, not to either gain. So if you look at from a theoretical perspective, you feel like, it's, why I entered into this, because I would have, but we never knows what is going to happen in the interest rate market and what would be the resultant prices. So when we hedge against the futures, we know exactly this is going to my position. So it may go either direction. I am not worried, but I am certain of my transaction value. Okay, so let's look at some fundamentals. The terminology we talk now, these I think most of you know this, but there are others that who don't know. In a market, in any market, there are different terms we use. Cash or spot market. Now, market for any asset where the buyer tenders payment and takes concession of the asset when the price is set. Okay. Now, forward contract. Now, cash means, of course, cash means immediate. Spot means usually it's about 2 days settlement, but not with a time cap. But forward contract is an asset where the buyer and the seller agree on the asset's price, but defer the actual exchange until a specified future date. Okay, so basically, forward contract is a contract and you entered between the buyer and seller today, but delivery take place at a future date. Okay, so that is called a forward contract. Then let's look at the difference between usually we call about futures as well as forwards. So what is the difference in characteristics? In general, the forwards and the futures both serve the same purpose. It's a hedge against the possible future adverse movements of, here I am referring only to the interest rates. It could be applied for any other thing, equity, commodity, anything. So now, if you look at futures contracts, those are more formal because those are traded on a formal exchange. Now, as I said earlier, if you look at equity market, that is formal. I mean, you buy and sell in a a market where buyers and sellers come into the market, and all these settlements are taking place through the exchange. So it's a formal market. Similarly, futures contracts traded on a formal exchange. Now, usually internationally, one of the main market is Chicago Board of Trade and the Chicago Mercantile Exchange. It's a formal futures contract market. The second important thing is, now these are standardized instruments. Because you can't, because in the market, there are set values, set standard, and set delivery date. So we can't have a delivery matching date which suits our requirement. Now let's say I need to hedge interest rate position of a liability maturing in let's say 40 days time. So there is a liability maturing in a 40 days time. I want to match or I want to hedge. Now, if I go to the futures market, I don't find the futures with the matching similarly maturing in 40 days time, because these are given maturities. I can't find a one with suit my own requirement, which exactly matching. So I have to either find a future which matures before my maturity date or after my maturity date. So it is somewhat future closer to my maturity date. So because these are standardized, because I can't have an exact future contract in the futures market which exactly meet my own requirement. So that is the important thing. But of course, we will come to the forward contracts a little later. But forward contracts are informal contracts between buyers and sellers as per their own agreements and own requirements. So it is more tailor-made, but these are standardized. And also in a future market, you have to put the margins, Now, generally, even if you look at a stock market, if you trade equities through margins, you have to maintain the margin on a daily basis, depending on fluctuation on your portfolio values. Now, similarly, in a futures market, now when you buy or sell a futures contract, you have to mark to market because the value may drop. Okay, so whenever there is a significant drop in value, so you have to mark to market the value through bringing relevant cash to ensure there won't be any defaults. So also positions require deposit equivalent to performance bond, because to guarantee the both parties honor the contract, so there is a deposit equivalent like initial margin which act as a performance bond. So there won't be any risk to the exchange. So let's look at the difference between forward and futures contracts. Now, as I explained, the futures are exchange traded, formal exchange traded instrument, which is standardized. So you can't match your requirements exactly the way you need. But forward contracts are over the counter, off the market. So, and it is up to the two parties, the buyers and sellers, to negotiate the terms and conditions and match their requirement. So it may not necessarily involve standardized asset. And like futures, no exchange of cash until the expiration, and also no market to market. But the problem is in the few forward contracts, what is the main problem? What do you think? When the contracts are taken place in this manner, so what could be the major problem? Anyone? answers. What do you think? What is the major problem? Compared to the futures contracts, what would be the problem in a forward contract? Many positives, but what is the main negative? Can someone tell main negative?
Volatility of exchange rate.
Sorry?
Volatility of exchange rate.
Volatility of?
Exchange rate.
Now we are talking about the interest rate risk.
Oh, okay.
Okay, not the foreign exchange risk. So what is the main problem in here? I mean, it may be common to foreign exchange also, but what is the main problem in a forward? I mean, this problem is common to even a foreign exchange contract. So what is the main problem?
Either party can be default.
Yeah, yes, you are right. So there is a high default risk. This is just an agreement between two parties. Now, why it is not prevailing in the futures contract? What is the reason?
There is an agreement in between.
Agreement can default anytime, but how it is protected?
Through an exchange house, the transaction being.
Yeah, exchange house, how we learned previously. So there are other
Daily market to
requirements
market.
because positions require daily market to market. You have to have a deposit like a performance bond. So it is covered through several instruments. You see, there's a formal exchange and positions require daily market to market and also require deposit. So performance bond is there, right? But here it's an agreement between two parties. Let's say two banks, Bank A and Bank B, enter into an interest rate forward contract. Okay. But this is agreement, formal agreement is there, but still there is no protection if somebody defaults. And can take legal action, but the protection is not there like a futures contract, okay, which is traded in a futures market. Okay, so that is the main difference. Then if you look at futures market, you have to have an initial margin, cash deposit, with the exchange simply for initiating a transaction. Initial margins are relatively low, often involving less than 5% of the underlying. So this is the common thing in any futures market. You start with the initial margin, and it is not a big amount, but it is protect to a certain extent as the value of future contract goes ups and down. Okay? Then you have to have a minimum deposit required at the end of the each day, depending on the price, because futures price also fluctuate like a spot market price. Now take example of the stock equity changes daily basis. Then here also the interest rate related instruments value will change. So depending on the change, your future price also change. So that if there are adverse fluctuation, you have to ensure that you maintain the margin at a particular level. So the exchange won't allow you to go below because you are supposed to maintain the margin. If you don't, exchange will naturally sell your futures or whatever opposite will happen through the exchange automatically because you don't have any choice. Okay. Margin requirements, unlike margin account for stocks, futures margin deposit represent a guarantee that a trader will be able to make any mandatory payment obligation. So it's a future margin is a some guarantee. Trader will be able to make any mandatory payment obligation. It's like a performance bond. Okay, so that is the guarantee when you do the trade through a futures contract. So you are protected from your contract, which is not there in a forward contract. Okay. So let's move on to the margin. These are just background information about these derivatives. So we will move shortly to real risk management part. Marking to market is a daily settlement process where at the end of every trading day, traders' margin account is credited with the gains and debited with any losses. So whenever your future price goes up, so you will end up with if you end up with a gain, then you will whatever the gain will be credited to your account. Okay. And if there is a loss, then that will be debited to your account so that your value will come down. This is where you need to deposit cash whenever your margin value goes down. Particularly now, let's say there are continuous losses in your futures contract over the next, let's say, 10 days, and your loss will be such a way that you come to the level of maintenance margin. Then immediately the exchange will tell you to bring the margin up to that level in addition to whatever other requirements you are not to comply. Variation margin, the daily change in the value of margin account due to marking market. So, due to marking to market, there's a change in the margin account, value of the margin account. So that is called the variation margin. Expiration date. Now, every futures contract has a formal expiration date. So when you buy the futures contract, we will look at some examples in futures markets. Unfortunately, we don't see it in local context here, but maybe when these markets are developed soon, then definitely you can see similar markets here as well. So the futures contract has a formal expiration date, and on the expiration date, trading stops and participants settle their final positions. Now, let's say I buy a 3-month futures contract that is maturing in, let's say, January 3rd. So I have a futures contract on a maybe interest-related instrument maturing in January 3rd. Okay. So basically on that date, so that is the date my future contract expires. So there won't be trading of that futures contract thereafter, right? So what I'll do is I have to, let's say I am the buyer and the seller has to deliver my, contract asset, and I have to buy. Or the difference between the buying and the, future price prevailing at that time, I have to, either party has to settle depending on the price. Okay. If the price goes up, the seller will give me the difference. If the price comes down, I have to give the difference to the seller. Okay, so that's how it takes place. Less than 1% of financial futures contract experience physical delivery at expiration. Most traders offset their futures position in advance. Now, physical deliveries is rather low. That is less than 1%. So most are the settlement. So it's a settlement between the two parties, and also they offset the position in advance. Whenever they see the opportunity, they offset through the opposite position. Like if you have a buy futures contract and I realize price is gone up, then I will offset through the sell, right? Then this is the important part, common 90-day euro dollar time deal. So this is the instrument many banks use for risk management with respect to short-term interest rate. Okay. So what is a euro dollar time deposit? Okay. That is a dollar deposit. Dollar deposits which are issued in countries other than US, euro dollar. Euro dollar means dollar denominated instrument issued by other countries other than US. Okay, let's say any country, any bank, if you issue a US dollar deposits, okay, that is called a euro dollar deposit. Okay, so to manage the interest rate risk, you can use euro dollar time deposit futures in the futures exchange 90 days. So this is short term like forward rate agreement. This is a short term risk management instrument. So underlying asset is a euro dollar time deposit with a 3-month maturity. Okay, so the maturity is 3 months, 90 days. The euro dollar rates are quoted on an interest bearing basis, assuming a 360-day year. So when it comes to most international euro dollar time deposits, there are day conventions. In the world, different exchanges use different day counting conventions. Now there are. If you look at Sri Lanka, usually we follow in interest rate related markets, bond markets. What is the day count convention we follow in the case of especially bonds and all? Anyone? What is the day count convention we follow here in Sri Lanka? Anyone? What is the day count convention? Someone at least here in Sri Lanka? Someone? What is the day count convention? Anyone? And those who are in the trading platforms, you should know. 364, right? If you look at our treasury bills, issued that 91, 182, 30. So our day count convention is 364. Okay. Now certain countries, most US market 360. Certain countries 365. So it is a day count convention. Now euro dollar deposits, because this day count convention is important for calculation of interest rate. So when we assume the day count 360, the interest rate is quoted for 360 days, not 365 days. Okay, so whatever the interest rate for a particular period is based on 360 day count. So day count convention in a particular country is very important. So that is the base for any interest rate calculation. So each euro dollar futures contract represent $1 million US. Okay. So if you want to buy or sell a euro-dollar contract, one contract is $1 million. Okay, so that's what I said. If you want to hedge your position, you cannot exactly match your position because the contract size is fixed. Now, let's say you have a 3.4 million dollar position you want to hedge in your balance sheet, interest rate related exposure. Now, how do you do it? You want to hedge interest rate related position in your balance sheet. Let's say liability, $3.4 million. How do you hedge it? Can someone tell? In the euro-dollar, using euro-dollar futures contract. You have a liability position of $3.4 million that you want to hedge against the interest rate risk using the 3 months euro-dollar deposits. How do you hedge that?
Create an asset matching with that term, 3 months.
That's right, but how do I mean? If you look at this contracts, how you can use this using the contracts? This euro-dollar futures contract. How do you do it? Tell me, like, how many futures contract you need to buy or sell?
4 contracts.
Okay, I mean, they'll know by how do you do it? How many contracts you need? Just for the explanation, it could be buy or sell depending on the situation. So now you have 3.4 million. So there are contracts of $1 million futures contract. It is a simple thing I am asking.
4 1 million contracts.
Sorry?
4 1 million contracts.
4 1 million contracts.
Yes.
Okay. Okay. So now 3.4 million means we cannot. We can't buy 3.4 million contract in the futures market. Let's say we want to buy futures to hedge interest rate risk. Okay, let's say we want to buy some dollar futures contract. Okay, depending on the scenario, it could be buy or sell. But let's say if I want to buy, I can't buy to match my requirement because the contract sizes are 1 million. So the 2 ways I can do, I can either hedge partially using 3 contracts, so that means under hedging, or I can use 4 contracts. It's called over hedging. So because I don't have I can't buy or sell 3.5 million contracts. So that is the problem. You can't match exactly. So this is what I want to explain. So that depends on the contract size. 1 billion, so you cannot match your requirement exactly the way you want. And also, these contracts maturing in 3 months after the contract expiration date. Okay, so probably I may not be able. Let's say if I want to match a particular date I want, because my asset or liability risk is arising after a particular number of days, so I may not be able to match exactly the way I want, right? Okay, 90-day euro-dollar time deposit futures. The 40 separate contracts are traded at any point in time as contracts expire in March, June, September, and December. So if you look at this standardized contract, usually they exchange in March, June, September, and December each year. So I cannot find a contract which may mature in between, like to my exact requirement. So the 2 problems, the maturity and the contract size. So buyers make a profit when futures prices rise or the interest rate fall. Sellers make a profit when futures price falls or the interest rate rise. Okay. So 90-day euro-dollar time deposit futures contracts trade according to index that equals 100% minus futures interest rate. Okay. Now, if you take now all these, if you look at the market, there is an index, like the price of a like equity, you get a price, but here there is an index. Now, index means the 100% minus the future interest rate, futures interest rate. Now, this is futures means not the future, futures instrument. Okay. So that means if you see futures index 94.5% means the futures contract interest rate is 5.5%. That is the 100 minus 94.5%. So each basis point change in futures rate, change in futures rate equals to $25 change in value of the contract. So when the futures interest rate changes by each basis point, your value changes by $25. Okay. So that is because our contract size is 1 million. Future contract period is 90 days divided by 360. Here it should be another zero, I think, 0.001. Another zero, because 1 basis point means 0.01%. So that should be, you should get one more zero here. Yeah, one more zero. So it's $25 change. So likewise, when you see the futures rate change by 10 basis point, your value would change by $250 per one contract, right? Now this is just for your explanation how these futures prices indexes are shown in the futures market.
Excuse me, sir.
Yes.
Sir, can I ask a general question here?
Yeah.
In this course context, which area currently are we covering, sir?
Sorry?
In the course context, risk management course, which area are we covering currently? I mean, I'm just going
interest rate risk.
That is the model 1, sir. Are we covering on the syllabus?
Sorry?
Are we covering the model 1 in the syllabus, like introduction to the risk management process?
No, we started with the market risk. Introduction and the market risk. This is what we have been doing last few weeks. We did the introduction and we started the market risk. Haven't you been in the class for last 3 weeks?
No, I've been there in the class. I just missed one class, but I'm just going to the context which was given to us in the syllabus and trying to match where are we actually on the course.
We started with the market risk introduction, then market risk module. Okay, so there is a market risk module. So under market risk, we are covering the interest rate risk part. Right?
Okay,
clear?
so it's not okay. Okay, sir, thank you.
Okay. So probably you will, once the market risk part is completed, you will come to the credit risk, operational risk, and so on. Okay. So if you look at market risk, there are 4 components. So here still we are on the interest rate risk part, and then you have the equity and also the foreign exchange. Okay.
Okay.
So under
Actually,
market risk, those are the,
I thought we are starting from the beginning. I'm sorry about it.
Beginning means?
No. I mean, I just went through them. I thought we are starting from module 1, but now I think we are in module 3, like as you said, management of market.
No. This is still part of the market risk.
Yeah, understood.
Okay, so it's still we are on the market risk, even market risk, interest rate risk, because if you look at market risk, we have interest rate risk, equity risk, foreign exchange risk. So still market risk, interest rate risk part. I think that's how I didn't see the module. Probably I don't know how it is given in the
No, no,
order,
sir.
but
Now it's clear for me. Like we are at the market. That's a module 3. Okay, thank you, sir.
okay. Thank you. So this is how these futures are listed in the stock exchange. The futures exchange. So you see each day. Now, if you look at stock market, stock market, you get the every day your stock prices, no, high price, low price, the closing price, average, and all those price increase or decrease. So similarly here. Sometimes some of your international banks may be using for their risk management euro-dollar futures, but may not be our local banks. But in time to come, when this market is developed now, I think we are also going ahead with development phase of our stock exchange and the markets. So sooner, I think these markets will appear in Sri Lanka as well. So with that, I think probably you bankers can have an option to trade in futures markets as a risk management tool, right? So I think it may be useful that you understand the concept. Then it may be highly useful how this trading will take place. So it's open, high, low, and the settlement price. And I want to highlight these few things. What is this yield? Can someone tell what is this yield? Anyone? Can anyone observe anything? What is this yield means? What is this yield? Anyone? Just to see and derive anything. Oh, okay. Yield is the difference between 100 and the settlement price. You see, that is the yield I mentioned earlier. That is the interest rate yield. So interest rate drops means what happened? Price. Futures price. Can someone tell? Interest rate drops, what happens to the futures price?
Why should go up?
Huh?
Why should increase?
Price?
Increase.
Yeah, price will increase. Okay, interest rate drops, price will increase. So that should be the, that is what is happening in the futures market. So always, if you get the price and the yield difference, that is that's not the price, the face value, the 100 minus yield should end up with what you call the price of a futures contract. Okay, so those are published in the what you call the daily basis with the volumes traded. Okay, so here if you look at the last one, the two columns and the yield convert to settlement price is the euro-dollar future rates as 100 minus settlement price. 100 minus settlement price is the futures rate. 100 minus settlement price is the futures rate, right? Okay, so let's move on to some more theory behind yields. The basis. Now, what is the basis? Now, basis is the cash price of an asset minus the corresponding futures price for the same asset at a given point in time. Now, if you take any asset, it has a cash price and a futures price. Okay, what do we mean by cash price and what is a futures price? Okay. what is the cash price? What is the futures price? Tell me. With example, can someone explain? What is the cash price and what is the futures price? Futures price and cash price. Now let's say you have euro dollar deposits. Now you have US dollar deposits in your balance sheet. Okay. So if you want to place more deposits, okay, so what is the rate at which you place the deposit in the current market immediately? But similarly, in the futures market, there are euro dollar time deposit futures are also traded 3 months. So that is the rate at which you can buy euro dollar financial futures. The cash market and the futures market, right? So for financial futures, the basis can be calculated as the futures rate minus the spot rate, right? Futures rate minus the spot rate. It may be positive or negative, depending on whether futures rates are above or below spot rates. Okay, if the future rate is above the spot rate, then it is a positive. If it is below the spot rate, then it is negative. Okay. May swing widely in value far in advance of contract. So the difference is much higher well in advance of the contract expiration. So before the expiration of, well in advance of the expiration, these rates may go up or down. Now this is an example I can highlight on a December 2005 futures rate contract, right? So you see this is the interest rate, this is the expiration date. Now this is expiration in December. So this is the cash rate in the cash market. This is the futures rate in the same instrument futures market. Now you see before the well in advance the maturity. Now if you look at March 10 up to like August, this is a significant fluctuation. And then futures rate is coming closer to the cash rate towards the expiration. Okay, so basis will be high well before expiration, but when close to the expiration, the basis will become lower and lower, close to zero. Okay. Now let's take an example of a hedging. Now, bank anticipates needing to borrow $1 million in 60 days. The bank is concerned that rates will rise in the next 60 days. Okay. Now, let's say, forget about now you want to borrow $1 million in 60 days. Right? Now, but you don't want to borrow now, only in 60 days. Now, let's say your bank needs to borrow $1 million in 60 days. Now, what is the risk to you? What is the risk to you?
Since the interest rates are increasing, bank has to pay more interest if we go and take after 60 days period.
Exactly. So your concern is the rising interest rates. let's say after when you want to borrow in 60 days time, dollar deposit rate goes up, or sorry, dollar borrowing rate goes up, then you are in trouble. Trouble in the sense your cost will be go up. But you don't want to borrow now also and pay interest for 60 days. So how do you use futures contracts? So simply, you can short futures, euro-dollar futures. You can short. So how it happens? If the interest rate rise, your short position will increase in value. Okay. So you sell today. So your position will increase in value. But in the borrowing market, interest rate high, you have to pay additional interest rate, right? So the cash market, you will end up with a loss. Let's say now you plan today's interest rate is 6%, but in 2 months' time, interest rate goes to 6.5%. Let's say 7%. So what is the loss to you in the cash market? So you want to borrow 1 million in dollars. Okay. So what is the loss to you if interest rate goes up to 7% from 6%? 1% of 1 million for 60 days, right? So, but now you short futures. So futures price will drop, but your position value will increase because you can sell at the agreed futures price. So in the futures market, you make a gain, right? You make a gain. But what you do is how the settlement take place. Now you short means you are selling. But when the interest rate rise, the futures market value will drop. Then what you do? You buy the futures at the higher interest rate, means lower price. So you will end up with a positive gain in the futures market. It may not be in the same amount, but we will see some examples. But at least you are covering partially with your 1% increase in the cash market. So that's why with financial futures, which often cannot be eliminated. I mean, you can't 100% eliminate your risk, but you can reduce, right? So the traders normally assume basis risk. In that basis might change adversely between the time the hedge is initiated and closed. So it may be adversely changed. Now perfect hedge. Now, perfect hedge means gains from the futures position and losses from the cash position offset each other, which is very difficult. Like earlier hedging, we cannot have a perfect hedge, no duration hedging. Same. Now, just to show you how it happens, example. Now, let's say you have a euro-dollar future contracts on March 2005 trading, which is maturing in December, expiring in December 2005. So let's say you buy euro-dollar futures at 95.91. So what is the interest rate market offering? What is the interest rate of futures? So what is the future rate? Can someone tell the future interest rate?
4.09.
Yeah, 4.09. Okay, 4.09 is the yield, futures rate. So if the futures price rise, okay, futures price rise, you will end up with a gain, isn't it? If you buy a future, the futures price rise, you will end up with a gain. If you sell a future, so that's why if you buy a future, if the future price rise, you will get gain. Future price falls, you will lose. Clear? Similarly, if you sell a future on that day, price rise, you lose. Price drops, you gain. So that is the second chart. Okay. Right? Say, let's say interest rate falls. So this is what typically happens, interest rate falls. Okay, interest rate falls. If the interest rate falls, what happens? If the interest rate falls, what happens in the interest rate fall? Futures price will? What happened to futures price? Interest rate fall, future price will? Okay, interest rate fall, future price will? What happened? Go up. Okay, go up. The future price will go up. But on the cash market, price will come down, so which you end up with a loss. So the futures position gain will be offset by the cash market loss. Okay. So this is how an exact hedge will take place. Similarly, take a short futures market. Now you have sold the futures. When you sold the futures, any price increase will result in a loss to the futures market. Right? But any price decrease will result in a gain because you have sold the futures. You have sold at a higher rate than the prevailing price. So you end up with a gain. But in the cash market, it is the opposite. So your hedge position will be, loss will be offset by the gain. So that is the, I mean, in practice you can't perfectly hedge, but you can somewhat minimize your risk using the right instrument. So I will explain to you an example, then you will realize. But before that, we will cover some theoretical part before we move on to this example. Long hedge, and short hedge, how it takes place. Okay. So let's cover two more theoretical part before we explain the practical scenario. So basically, when you use futures contracts for hedging, first thing is you have to identify the cash market risk exposure to reduce. Okay. What is the risk you want to reduce? Because without which you don't know what to do. Okay. Now let's say you have a corporate bond trading in the market. Corporate bond trading in the market. The corporate bond trading in the market. Now you want to sell it in 3 months' time. You want to sell it in 3 months' time. Right? You have a corporate bond in your balance sheet. You want to sell it in 3 months' time. There is active trading for corporate bonds in the market. So what is the risk to you in the cash market?
When the interest rate increase, then it goes down.
Sorry? What is the risk to you? Can someone tell me? You have a bond in your portfolio which you intend to sell in 3 months' time. Corporate bond, interest rate related corporate bond. Okay, so you are trading it. Your target is for whatever person, sell it in 3 months' time. What is the risk you foresee? Because this is the first thing you have to understand. Without understanding the risk, you can't find out the hedging mechanism. What is the risk to you? Very simple. What is the risk to you?
If the interest rate increases, they tend to
Yeah, interest rate increases.
Investors will tend to settle the bond and to reinvest in a higher.
No, you are the investor. You are holding a bond.
Yeah.
And your bank has some amount of bonds. Okay.
When the interest rate
So
goes,
what interest rate increase? What
value
happens?
goes down.
Huh?
Value goes down.
Value drop downs. Come down. This is the problem. Now you have 10 million rupee worth of bonds. You want to sell it in 3 months' time. Current market yield is 8%. Assume current market yield is 8%. So if you sell today, you can realize 10 million. You have 10 million worth of bonds. Current market interest rate is 8%. So if you sell it today, you can realize 10 million rupees. But you don't want to sell it today. You want to sell it 3 months' time. The risk is, let's say interest rate rise to 9%. Then your value may come to, we have to work out, but say, for example, 9 million. So if you wait till 3 months' time, if the interest rate goes up, you can only realize 9 million, not the 10 million today. So there's a potential risk of keeping these bonds to sell in 3 months' time if the interest rate rises. That is the risk. Now, when you identify the risk, we have to determine what to do. Okay? What to do. So that is important. So given the cash market risk, this is the cash market risk. Determine whether long or short futures needed. So you have to decide what to do. Am I going to short or long? We will come to that later. So you identify the risk exposure, decide what to do, long or short the future, and select the best future contract. Now you can't exactly match, but select the best one to manage your exposure and determine the appropriate number of futures. Now I said, I want to, I have 10.4 million. So let's say contracts are 1 million rupees. I can't find 10.4 contracts. So either I have to go with 10 contracts or 11 contracts. So buy or sell appropriate. So now you buy or sell depending on the risk exposure. Determine when to get out the hedge position, either by reversing the trade or letting contracts expire or making or taking delivery. So once you enter into a contract, in between you can do many things. When you have a gain, you can reverse it. Or wait till contract expires. Or take a delivery. Also verify that futures trading meets regulatory requirements and banks' interest. So then look at your regulatory requirement. Now there may be regulatory requirements as well as your bank's internal risk policies. Now look at a long hedge, buy futures. Now at what time you buy is appropriate. Long hedge, appropriate participant who wants to reduce spot market risk associated with a declining interest rate. So if you foresee a declining interest rate, what sort of hedge you should look for? Long hedge. If the spot rate decline, futures rate also decline. And futures value will go up. So you sell the futures contract at that time and make a gain. But the spot market, you make a loss. Spot market, you make a loss. So loss in the cash market is at least partially set off by a gain in the futures contract. For example, on March 10, whatever, let's say 2005, your bank expects to receive $1 million payment on November 8, 2005 and anticipates investing the funds in a 3-month euro-dollar time deposit. So you expect to receive 1 million in November, let's say 6 months time. March, not 6 months, it's about 8 months time. Yeah, 8 months time. But what you plan to do is this 1 million to be invested in a 3-month euro-dollar time deposit. Okay. So the cash market risk exposure is that the bank will not have access to funds for 8 months. So you don't get the funds for 8 months. So that is the risk. In March 2005, the market expected euro-dollar rates to increase sharply as evidenced by rising futures rates. So futures rates rise means what? Value of futures contracts will come down. Similarly, value of cash market, euro dollar deposit also come down, right? So the best futures contracts will generally be the December 2005. Now this is based on what is available in the market at that time. 3-month euro dollar deposit futures contract, but that depends on the current environment. So at the time of your risk management, you have to find out the best instrument. I mean, let's say for this example, that is the instrument you can find in the market at that time. There is a future contract maturing in 2005 December, 3 months euro dollar futures contract, which is first to expire after November 2005. So after 2005 November, this is the first one to expire. So you have to identify the immediately maturing contract closer to your contract proceed maturing date, right? The contract that expires immediately after the known as the cash transactions date is generally best because it is the futures price will show the highest correlation with the cash price. So, I mean, that's what I said. Now, when you go to a standardized futures market, you can't match your requirement the same way you want, right? Exactly. See, if you have a futures contract maturing on November, you are fine. But here it's in December, which is the closest, right? So if you look at the timeline, in March 2005, March 10, you anticipate investment of cash, but in November, okay? Right? So then what you do is you buy a futures contract. Okay, so you buy a contract on November 8, 2005. When you get the funds, you invest that 1 million in whatever euro dollar deposit. Okay, and you sell the futures contract. Then your risk would be addressed. Okay. Right. So the contracts will mature on expiration date of December 2005. Right. So the short hedge is the opposite. Long hedge associated with the declining interest rate. Short hedge is associated with the increasing interest rate. You sell the futures. When you see interest rate is going to rise. If the spot rate rise, futures rate will also rise and the value of the futures position will decline. So any loss in the cash market is partially offset by the gain in the futures market. Right? So this is the same example we talked about. In 3 months, you want to sell a bond. If the interest rate rises, price will drop in the cash market. Similarly, futures market. But you sold the futures at current rate. Then interest rate rise means future price will drop. That means you will gain in the futures market. So the loss in the cash market will be offset by the gain in the futures market. So this is example on March 10, 2005. Your bank expects to sell a 6 months 1 million euro dollar deposit. Okay, so you want to sell on August 15, 2005. Cash market exposure is that interest may rise and the value of the euro dollar deposit will fall. So when you want to sell, your risk is that the market interest rate will go up. Then you have to pay additional interest rate. So what you do? You sell futures contract. So that cash market loss offset by the futures market. Okay. So the example, so anticipated sale of investment. Okay. So there's anticipated sale of investment. Okay. Then you sell a futures contract today and you sell 1 million euro dollar deposit. That means you raise deposits, but interest rate has gone up, so you have a loss. But since the interest rate goes up, futures contract price also come down. So, but you have already sold futures. So you can buy at a lower rate compared to you agreed to sell at the time of March 10, 2005. So you make a gain here. You make a loss here. Right? So you can reverse the trade. Okay. So let's look at this in practice, how it happens. Now on this particular day, 3rd March 2005. So bank anticipate 1 million euro dollar deposit in 127 days. That is on this August 17th. So let's say currently euro dollar deposits are at a rate of 3%. Then today in the futures market, the very close contracts maturing in September, trading at the rate of 3.85 futures rate. So the price is 96.15. So basis is 3.85 minus 3%, 0.85. So that means futures are trading at a 0.85 basis point, 85% higher than the cash market, right? Then bank sells today 1 million euro dollar deposit. 1 million euro dollar deposit. Sorry, not today. In the cash market in August. So August bank issue a euro dollar deposit. Now your bank issue a euro dollar deposit. That is euro dollar means dollar deposit. Now here euro dollar means it is issued in somewhere other than US. So when your bank issue a dollar deposit, it is actually a euro dollar deposit denominated in dollars but issued in Sri Lanka. So that's a euro dollar deposit. Now interest rates have gone up. If I issue this deposit in March, I would have issued only at 3%. But now I have to pay how much? 4%. So because of the time factor, how much I lose? 1%. So remember, earlier I mentioned every basis point change, I will either lose or gain by $25. So how many basis point change here? 1% means how much?
100 basis points.
100 basis point. That means 25 into 100, 2,500. So my additional cost would be 2,500 for 1 million. Now let's say, now I just want to explain the gravity of the issue. If I want to issue 10 million deposits, how much I am going to lose? Lose in the sense I have to pay additional interest. 10 million euro deposits. Ten times. So 1 million, 2,500. 1% increase will result in additional 2,500. If I want to issue 10 million deposits, I have to pay incur additional 25,000. So that is the danger for the rising interest rate. If you want to raise more deposits, even in local rupees, is that, let's say you want to raise some deposits in 3 months' time, or you want to raise 100 million worth of deposits, not today, 3 months' time. Okay, your bank proposed to issue 100 million worth of deposits in 3 months' time for whatever purpose. But today market interest rates 8%, and 3 months' time it goes to 10%. So how much you have to pay additional 2% on 100 million for whatever period? So that is a 2 million additional cost to you. Depending on the period, you can compute the exact amount. So now we want to minimize this rising interest rate when I want to raise deposits. So on March, I will do what? The expectation interest rate rise, then future price will drop. I will sell futures contract. Closest is to August is September. Now currently trading at 3.85. Let's say in September, okay, so not in September, in August, I want to raise the deposits. So I buy 1 September contract in August. What is the rate I am going to buy now? At 4.14, because the cash market rate has gone to 4%. Similarly, futures market rate also has increased, but not by the same amount. It's 4.14. So at a price of 95.86. So I sold at 96.15. Now I buy at 95.86. So I am making a gain of how much? 0.14%. That is the basis. So my futures profit is 4.14 minus 3.85, 0.29. That is 29 basis point. So how much I save here? 29 into 25. So I lose 2,000. Opportunity loss is 2,500 in the cash market. Opportunity gain in the spot futures market is 725. So if I'll put this way, if you don't have hedge this futures market, what would be the loss, opportunity loss to you on whole this transaction? You don't have any futures market. What would be your opportunity loss for the incremental expenditure on this whole deal? Can someone tell me? We don't have any futures market. Simply, we have only the cash market. We didn't hedge. So what would be the loss to you as a rising interest rate?
$2,500.
Sorry?
2,500.
2,500. This is the loss. But now what is the loss?
1,775. That is net of 720.
Exactly. As a result of this futures hedging, we saved 725 through the hedging, and our effective loss would be now 1,775. So this is not a perfect hedge, but we have reduced the risk of rising interest rate. If we didn't have a hedge, we would end up with additional cost of 2,500, but now we would end up with only 1,775. That means even though the cash rate is 4%, because of this 0.29 increase in the futures market, the effective rate we are going to pay is only 3.71. Right? Clear? So that is how we can use the futures market instrument hedge against your risk. Right? So first you have to identify the potential risk and identify what is the right way of doing, short or long, then identify the right product in the futures market and do the relevant hedging. Right? Any questions so far?
So are banks allowed to invest in futures? In Sri Lankan banks
No,
are allowed to
we
do
don't have a futures market here, no, so that is the problem. But I don't know whether any foreign banks doing any euro dollar hedging, anything like that for hedging purpose when they
with the
release.
central bank regulations. Is it allowed to like do the foreign currency trading?
No, foreign currency trading means you can have foreign permitted transactions, but I'm not sure whether any trading for hedging is taking place. I'm not sure whether any trading for hedging will take place, but limited foreign currency transactions you can do. But I will double check on that. But usually this happens, when you have exposure to international transactions in the international market side. But only thing is local banks definitely not. But what you call foreign banks, if there are anybody from Standard Chartered or HSBC who can clarify, but I will check on that exactly.
For Sri Lankan, the past hedge for past Sri Lankan government hedge transaction, I think there were two banks and again the foreign bank by for the transaction. No?
That is
the oil one sometime back.
Yeah, that is a different methodology. That is
Right.
not this hedging. That is a cap and flow.
Okay.
I will come to that towards the latter part. That is a hedging through a interest rate caps and flows.
Right. This is on purely demand and supply basis.
Yeah, interest caps and flows depend on commodity price.
Right.
It is a commodity, that is a commodity hedging.
Okay.
So we will come to caps and flows towards the latter part. So that is a different way of hedging of the pricing. So the buyer and seller agree on a particular cap, and then you curtail your price at a higher level cap. Limit beyond that level. Say if the price go below, let's say maybe 100 barrels per dollar, anyway we pay only that much, right? But there, I think it's different. That structure is you have a both long and short hedge.
Okay.
Cap and a flow. That is a collar. So the collar is it's a mix of cap and a flow, right? That is for a commodity. Okay. So that's an option, not a futures contract. I will explain when we come to the caps and flows about that. I think it's to a very later part. Now here, interest rate swaps and okay. Okay, this is the area. So cap, how it works, okay, and how it's work in a flow, put option and a call option, and how you have a collar. Caps, flows, and collar. So collar is a combination that cap and flow. We will look at precision stake and simultaneously in a cap and flow. I think that is a mixture of cap and flow, which is called zero cost collar. Now here, this example strategy, buy a flow on 3 months LIBOR at 2% and sell a cap in a 3 months LIBOR. So this is something like hedging, oil hedging. It's not the futures contract, right?
Okay, sir.
So we will look at caps and flows probably maybe next class. But again, very important now, all these days we are talking about swaps in the foreign exchange market, foreign currency swaps. All are, Chinese swap, Bangladesh swap, India swap, all these, common word swaps. Again, risk management tool. We will learn in detail swaps probably next week. Whole area of swaps we will look at. Cash flows in a swap, how it takes place. Of course, we are not going to discuss pricing, which is complicated, but basic structures of a swap, how it takes place. Okay, so with that, we'll stop for the day, almost 12:45. Any more questions before we wind up from anyone else? But the most common derivatives we use in local context is the forward contracts, which is very common among banks, especially FX forward. You will learn when you learn FX from the other resource person. You will learn about forward swaps, which is a small time swaps, which is called the forward contract. Then foreign currency swaps, okay. The interest rate swaps, that again very common, forward swaps, and off-the-counter options, because we don't have standardized options because we don't have a market, but off-the-counter options. Typically, your banks, if you look at your bank's balance sheet, you will realize the key instrument which you used as a risk management tools. Look at your balance sheets. Swaps popular, forward contract popular, off-the-counter options. Okay, right? Okay, so if we don't have any more questions, we'll stop here, and we will.
Sir,
yeah.
So please share that workings with Menaka for that case study on so that.
Okay, we will do that.